Hi, this is Swiatkowski for the Mortgage News Network, and I'm here at the Ultimate Mortgage Expo in New Orleans, and I'm joined by Ted Tozer, the president of Ginnie Mae. Ted, thanks for being with us today.
Thank you for the opportunity.
Ted, what's it like to be asked to come in and speak at an event like this and be able to address people in the industry?
I look forward to it. It's a great opportunity to talk to the mortgage brokers here and explain to them how things we're doing actually affects them positively and how we're both really important pieces of the housing finance structure.
Ted, let's talk about Ginnie Mae. How has the profile of the Ginnie Mae issuer changed over the last 5 years?
Actually, the shift we've seen going away from bank-dominated to non-bank dominated over the last 5 years. But what's critical about that, it shows the power of the Ginnie Mae structure. We're able to have a situation where, as banks, for whatever reason they decided, whether it was reputational risk or too costly to service, whatever the issue may have been, they pulled back. And we were able to seamlessly have non-banks fill in the capacity that they lost. Because basically we've gone from a situation where non-banks were probably 18-20% of our business 5 years ago. This year, there'll probably almost 2/3 of our business will come from non-banks. And that was critical to have the capacity being replaced by the non-depositories as banks left the banking sector.
Regarding the GSEs, they lowered their down payment requirements. How did this impact Ginnie Mae's market share, Ted?
Basically, I would think it really didn't affect it that much, mainly because as Fannie Mae and Freddie Mac lowered their down payment requirement, they also increased dramatically their credit quality if they wanted. Higher FICO scores, lower DTIs, and so the traditional FHA borrower that tends to have a low down payment, but also tends to have a little strapped for income and also be in a situation where their credit may not be that pristine. It actually continues to do well. Plus, we're in a situation also that the big news source of business for our lenders has been the Veterans Administration program, because that has tended to really be a major impact on the industry, now to the point where VA is comparable to the volumes coming out of FHA for the last couple of years.
With the increase in the Ginnie Mae issuers, can you tell us a little bit about the tools that Ginnie Mae is providing for support to those new issuers?
Again, we're trying to build our technology to be able to better grade our issuers to determine who can be successful in our program, and so we can actually put our resources where they need to be at as far as monitoring. We're also building out our issuer operational performance profile, which basically we announced it this past year, because basically Ginnie Mae, we perform really two functions. We perform a single securitization platform, the same thing that the GSEs are trying to build. So we want to make sure the operational requirements that the issuer is able to comply with, as far as reporting timely, their delinquencies, reporting their data timely. But also, too, another thing we're building out also is, again, this modeling, because another role we play is also to guarantee on our securities. So we take on the same role as the FDIC does when it guarantees bank deposits. So we have built both functions. We're trying to build out the tools and that we need to be successful, and both those responsibilities we have to the U.S. government.
Great, thanks. Ted, before we went on, we were talking a little bit about the increase in VA loans. You want to tell us a little bit? I was really surprised to hear how much it's been increasing.
Yes, actually over the last year or so, we've seen VA production being very similar to FHA, to the point where actually the first part of 2015, VA actually was slightly greater than FHA's volume. And it's mainly because of the fact that with the increase in eligible veterans eligible for the program, because of the people that served in Afghanistan, Iraq, or that actually were National Guards and reservists that were called up to become active duty, because you heard about a lot of that in the press the last couple of years. All those people have basically lifetime benefits, but they'll be able to get a zero down payment loan for a very nominal fee for the rest of their life. So that's going to tend to, I think, change a lot of the complexity of the housing sector for really high quality borrowers going the VA route in lieu of going to Fannie or Freddie.
Ted, what's the biggest challenge right now that Ginnie Mae faces?
I think the biggest challenge we're facing right now is, again, the landscape, having the amount of non-depositories we have. There's nothing wrong with non-depositories, but the issue we have is because they have unique challenges financially, mainly because of the fact that the biggest thing that our servicers need is cash. They need cash to be able to make payments for borrowers that are delinquent. So if a borrower is delinquent, you still have to make that pass-through payment to the bondholder. Depositories, by definition, have plenty of cash. They have all these deposits. A non-depository doesn't have that cash. And since I've been at Ginnie Mae, every issue we've had to shut down, it's been because of cash, not because of capital. And again, because of that, we really have to monitor them a little bit closer and just have the resources we need to manage that new type of issuer that's grown so dramatically over the last couple of years.
Thanks, Ted. And thanks for spending some time with us. This has been a pleasure talking with you and getting your insights. This is Swiatkowski for the Mortgage News Network here in New Orleans at the Ultimate Mortgage Expo. Thanks. We'll talk to you next time.
This is Mortgage News Network.